Okay, we're just going to give a few more minutes for everyone to join, and then we'll get started. Welcome. Okay, we're going to get started. Welcome to the joint webinar between Marsh Credit Specialties Practice and Coface North America. As many of you know, Marsh Credit Specialties delivers trade credit, structured credit, and political risk insurance solutions, as well as surety products, and has over 800 dedicated professionals working from 46 countries around the world to support Marsh clients. Some of you may also know Coface, which is one of the world's largest trade credit insurance and credit information providers, with operations spanning nearly 200 countries around the globe. We're going to use the hour to discuss challenges posed to businesses by the current economic environment and its impacts to global trade. During this session, we'll start with a short overview on trade credit and political risk insurance by Brandon Baker. He's a vice president at Marsh Credit Specialties Practice in the U.S. Brandon has been a trade credit and political risk insurance broker with Marsh for 24 years and is based in Charlotte, North Carolina. His primary responsibility is business development in the Southeast and Chesapeake regions of the U.S., and Brandon also works within Marsh Credit Specialties Global Clients Group, focusing on multinational placements, and is a team lead for trade credit business development in the U.S. chemical industry. We will then feature a global economic update by Coface North America's economist, Ruben Nizar, which will include the latest developments on the economic impacts of the pandemic, the global supply chain disruptions, the Russia-Ukraine conflict, and rising inflation and interest rates. Ruben originally joined Coface in 2016 with the Group Economic Research Department located in France. He was responsible for Coface country risk analysis of Africa, as well as contributing expertise to Coface analysis on the oil market and to the Coface Political Risk Index for 3 years. Then Ruben was appointed economist for Coface North America in 2020. He's based in Toronto, Ontario. Following this, John Goggin, who's Senior Vice President at Coface North America, will also provide his credit risk forecast for the energy, manufacturing, and chemical sectors. John has been in the credit field for 25 years. He has began as a credit analyst for Panasonic Industrial Company before transitioning into trade credit insurance. He has held various positions within Coface, and most recently is risk underwriting manager for the industry sector, which includes metals, construction, lumber, and energy. We will then conclude with a Q&A session with the panel consisting of the presenters mentioned, as well as Kevin Major, who's Senior Vice President at Coface Broker Relations, and Luc Fournier, Vice President of Sales for Coface Canada. Kevin came to the trade credit industry in 1996 after a brief banking career where he formally completed his credit training. With his background, he has been able to perform various tasks from underwriting to claims. Over the past 10 years, the last 2 of which have been with Coface, he's been working in broker relations. He's located in Hunt Valley, Maryland, and now manages the broker relations team at Coface. And also, after 7 years in Asia, including 10 in China, Luc Fournier decided to pursue his career in the banking industry with National Bank and HSBC Canada. During these years, he developed his knowledge and expertise in trade finance, as well as supply chain finance, leveraging trade credit insurance and other insurance guarantee solutions. Luc joined Coface Canada in December 21, and after 5 years at EDC, Export Development Canada, managing the relationships with all financial institutions. Brandon, if you would, take us to the next segment.
Great, thanks, Cam, and hello, everybody. Thanks again to all of you for joining us today. Before we have Coface delve into the latest economic developments, we just wanted to take a few minutes to review the basics of trade credit insurance, which is one of the main products that we here at Marsh Credit Specialties offer and Coface offer. I'm going to run through this in about 5 minutes, so apologies if I go a bit quickly here. On to the next slide, please. By way of basic overview, trade credit insurance covers non-payment of legal enforceable accounts receivable, loan, and lease obligations. And that would include both operating leases and financial leases. We can cover both export and domestic transactions, and we generally have two basic policy types, which are single buyer policies and then multi-buyer policies, which cover portfolios of receivables. Now, what we refer to as trade credit insurance, we are basically covering short-term payment obligations, which we define as up to 180 days for non-capital goods and services, and then up to 1 year for the sale of capital equipment or perhaps project finance transactions. So here at Marsh, we do offer credit insurance for medium-term and long-term multi-year repayment structures, but that falls into what we call structured credit insurance. Off to the right here, you can see a pretty thorough sampling of the trade credit and political risk insurance markets in the US. So these insurers, which include some Lloyd's of London syndicates, are those that currently have underwriters working on the ground here in the US and or Canada. But we do have access and routinely help our clients source quotes from markets all over the world, including London. And then on the next slide, we're just going to quickly talk about some of the primary benefits of trade credit insurance. We list 5 here, but due to time constraints, I think I'll just talk about the 3 main ones. So the first is balance sheet protection. And I think I'll lump risk transfer in with that because the insurance effectively results in you transferring up to 90 or 95% of the customer non-payment risk off your balance sheet and over to the insurance company. And we all know customer payment risk, it can be at times predictable and other times very volatile and unpredictable. So the insurance effectively allows you to fix your annual exposure to non-payment risk in exchange for a relatively small and predictable premium amount. So this might help you sleep better at night, so to speak, but having this protection over the balance sheet can also serve to increase confidence among your investors, your lenders, suppliers, and maybe even credit analysts out there at the rating agencies that are looking at your company. Next, we talk about using the insurance to help grow sales and protect market share. And the idea here is pretty straightforward, which is that using credit insurance to help justify the extension of longer repayment terms and the corresponding longer or larger credit limits could give you a competitive advantage and allow you to win more business and meanwhile protect your market share from your competitors out there who are trying to take it. Next is the financing benefit, which I think I'll tie back to the previous point on sales growth here. So obviously, if you start offering longer repayment terms to your customers, this is going to put a strain on your cash flow, extend out your days sales outstanding. So what many of our clients are doing is using the insurance to facilitate the off-balance sheet sale of receivables to a bank, either on a non-recourse or perhaps a limited recourse basis. So if you're selling your AR daily or perhaps weekly, that's going to help you reduce your DSO from say 1 to 7 days and help keep your cash flow strong. Selling receivables does come at a cost, but a lot of our clients find that they can pass both the insurance and the bank finance costs onto the customer in exchange for those materially longer terms. So, you know, they're getting more time to pay you and oftentimes are willing to pay for that. This slide of the financing section does cover more than just selling AR, but for time's sake, I'll just finish by saying that wrapping receivables with insurance can typically allow banks to lend a lot more through most types of bank credit facilities out there, including asset-based securitizations, ABL revolvers, factoring facilities, and confirmed payables finance facilities, AKA supply chain finance facilities. So I think that's my 5 minutes. So that concludes our overview on trade credit insurance. Thanks again, everybody, for joining today. And with that, Kim, I'll turn it back over to you.
Good morning, everyone. So I didn't hear you, Kim, but hopefully this is my turn to speak.
Yes, Ruben, sorry.
Thank you for having me. My name is Ruben Nizar. I'm Coface economist for North America. So I will be providing today a brief economic update, global economic update, sharing Coface view of the global risk environment in the current context. As you know, the news cycle has been very active recently. The war in Ukraine, the pandemic, the path of monetary policy are all in focus, and that's why I will try to outline today. So if we can start with the first slide. The broad outline of my presentation will follow the structure. So I think the current environment is very interesting because we've had, especially in advanced economy, a very strong recovery from the recession triggered by the COVID-19 pandemic. And going into 2022, we were saying at Coface that it would probably continue as economies around the globe continue to reopen with progress with the vaccination, but that it would lose some momentum after a very strong 2021. And that's what we expected. We expected advanced economies to lead the way and to continue to lead the way in 2022. So a bit different from what we had seen in prior to the pandemic in terms of global economic growth, but a pretty robust outlook. But at the same time, we warned that there were several risks and that the risk picture had probably deteriorated for 2022. And of course, we highlighted the geopolitical risks and the start of the invasion of Ukraine by Russia on February 24. Obviously reshuffled completely the picture and has completely changed the outlook for us. It has raised the prospect of slowing economic growth, while at the same time raising the inflation prospect, putting, and we've heard a lot in the past month, the word stagflation, which is coming back into fashion. So we have this new war, and although we don't really know when it will end, at Coface Economic Research Department, we believe that the impact of this war, even if a conclusion to the military and to the fights is found in the coming weeks, we think the impact will continue to be felt throughout 2022 and 2023 as sanctions that have been agreed and that are asphyxiating the Russian economy are likely to continue to impact the global picture. In this global picture, Europe seems to us to be the most exposed to the risks of recession in the short term. And this has definitely, the news this morning are highlighting again that the risk of a sharp slowdown in Europe is very important, with the European Union proposing an oil ban, a Russian oil ban by the end of the year, which would imperil growth prospects in Europe. In North America, although trade and financial leaks are lower, we also expect this, and we already seeing that the change in the inflation outlook that is partially a result of this conflict is changing also the path of monetary policy normalization and the outlook for inflation and interest rates, which will ultimately affect activity and trade in the coming quarters. And looking at emerging markets, we think that the current environment raised the risks of social unrest and political turmoil. So to move on, I'd like to start with Coface GDP growth forecast. As I was saying, after a very deep recession in 2020 because of the COVID-19 pandemic, the global economy has recovered quite strongly. You can see with our latest GDP growth estimate that in 2021, we estimate a 5.7% rebound after more than 3% contraction in 2020. As I was saying, the mix of growth has also changed, and because of faster access to the vaccine in advanced economies that help them to reopen their economy a bit faster, you can see that the contribution of advanced economy to global GDP growth in 2021 and as well in 2020, in our 2022 GDP growth forecast is estimated to be higher than what it was prior to the pandemic. So this was our key assumptions. But with these assumptions in mind, we were still expecting at the global level a strong recovery of about 4.1% in 2022, which would have been above the rate of global GDP growth that we had experienced in the decade prior to the pandemic. But as you can see with our latest revisions that were released this week, we have now revised this GDP growth forecast at the global level by about 1 percentage point. And a lot of this is directly related to the impact of the war in Ukraine. So most of our GDP revisions, as I'll show a bit later in the presentations, are due to revisions in Europe, but as well in North America and in several emerging countries. And our key assumptions in the current environment and considering the events in Ukraine is that this situation will create a lot of losers and a few actual winners from this situation. So definitely a deteriorated outlook directly as a result of the war in Ukraine. You can see from the right-hand side chart that we notably expect a very sharp recession in Russia, and it will start from here. Because although Russia is not a big economy, and that's what you'll see on the next slide, Russia is only the 10th biggest economy in the world. It's as big as Spain, so a fairly big economy, but not a major player. But it does play a very important role in global supply chains and in the global economy because it is a commodity powerhouse. So if we can move on to the next slide, please. You'll see that, of course, Russia is an important energy supplier, being among the top 3 natural gas and oil producers, but it's also a major and producers of agricultural commodities and particularly of grains, supplying a lot of markets in Africa and in the Middle East. You can see, for example, more than 25% of the global supply of wheat coming from both Russia and Ukraine. In addition, Russia and Belarus, which is also being sanctioned for its role in the current geopolitical situation, are also major exporters of fertilizer, and this is likely to impact way beyond the confines of Europe. For example, Latin America sources a lot of its fertilizer in Russia and Belarus. Finally, Russia is also a major exporter of key minerals, so industrial metals such as aluminum. Close to 10% of global exports are coming from Russia, and of several key minerals in the energy transition that we've talked a lot in recent years, such as the platinum group metals that includes palladium, platinum, that are in very high demand and that will likely squeeze supply in the coming month. And it's already starting to squeeze supply, which was already being stretched by in the environment of the post-pandemic recovery. So, of course, if we move on with the presentation, we can see that the impact of this heat on the Russian economy is going to be felt on inflation. Inflationary pressures are going to come from rising commodity prices. So we've seen energy prices rise meaningfully, and they've stabilized above $100 after reaching a 14-year high earlier in March. We are likely to continue to see a lot of volatility going forward in energy and global commodity prices. But overall, in 2022, we expect them to remain at very elevated level. And they were already, as you can see on the left-hand side chart, on a rising trend in 2021 due to the post-pandemic recovery, which was creating some stress on the supply of commodities. So we can see that industrial metals and agricultural commodities in particular are rising very fast. And even if some commodity prices have pulled back a little bit in recent quarter, and as I was saying, we expect prices to remain high going forward. So can we move on to the next slide, please? And in addition to this shock on inflation that is coming from the war in Ukraine, we are also seeing an additional inflationary shock that we were fearing, and that is coming from China. And this is the development with with COVID-19 in China. As you've probably seen in the news, COVID-19 cases in China have surged at the beginning of 2022. And in China, they remain committed to a very dynamic zero COVID policy. So it means that they are shutting the economy a lot. And you can see that with this right-hand side chart showing mobility heat map in some key metropolitan hubs in China. You can see the level of restrictions are being raised, and this will likely increase the pressure on global supply chains in the coming month and will likely translate into higher prices, with the supply being reduced again. Because although China is also a driver of demand at the global level, and the fact that they're shutting down their economy and that their economy is going to slow will probably put some upward pressure on some commodity prices, it is at the same time the main industrial hubs in the world, being responsible for between 15 and 20% of global manufacturing activity at the global level. So of course, with the main cities being closed, according to some estimate, you have about the top 100 cities, among the top 100 cities that represent about 70% of GDP, you have about 90% of them being closed. This will, of course, also impact supply, and in net, we expect these further lockdown to and these dynamic zero COVID policy in China to further translate into higher inflation, which will ultimately impact growth prospects with lower business investment and lower consumption in advanced economies. So if we can move on to the next slide, we are seeing that, of course, this backdrop of further inflationary pressures coming from lockdowns in China and the war in Ukraine are impacting an already unusual inflation picture, especially in advanced economies. So if you look at the left-hand side chart, you can see that in Europe, in the UK, in the US, inflation is at multi-decade high, and we are back to level of inflation that we had last seen in the 1990s, 80s, or 70s. You can even see that Japan, which had remarkably low inflation, has returned to positive inflation, which in itself is also a sign that inflation pressures are building. So, of course, with these further inflation shocks, we are expecting further upward pressure on inflation going forward, and this will likely put a lot of pressure on central banks to normalize monetary policy. But as I will mention when talking about the US a little bit later on, the Europe and the European Central Bank is not exactly in the same position as the Federal Reserve or the Bank of Canada in North America. If we look at emerging economies now on the right-hand side chart of the graph, you can see that if we look at the past 20 years, the current inflationary pressures are not exceptional, but they are definitely high. And you can see, for example, with the example of Brazil, that inflation is not only high, but they're forcing, and they have already forced central banks to front load their monetary policy response. And the Bank of Brazil was one of the most aggressive when it comes to tightening its monetary policy stance. So we've gone in the span of 12 months from an inflation picture that was described as being transitory to some kind of inflation picture that is now more persistent. And now the risk is that this inflation picture starts to become more entrenched and more permanent. So all this inflation picture is impacting our GDP growth outlook, as I was mentioning, because it will impact business investment. It will likely lower consumption as well. So all this will weigh on GDP growth globally, and that's what we can see on the next slide with our revisions to GDP growth following the war in Ukraine. So if you look at this map, you can see that the impact of the war is mostly expected to be felt in Europe. So of course, Central and Eastern Europe is more exposed to Russia and Ukraine, with more direct trade and financial links with these economies. So there, the impact on activity is expected to be bigger. You can also see that in Western Europe, we also expect an impact that is above one percentage point. So we have revised already our European GDP growth forecast by about 1.5 percentage points. And this is notably led by Germany and Italy because of their very high reliance on the Russian energy supply and Russian gas supply. But of course, the European bloc at large will feel the impact of this crisis in Ukraine. When it comes to North America, you can see that we forecast a milder impact. So it was an initial 0.4 percentage point revisions to our GDP growth forecast in the US, because although direct trade and financial links are low, the deteriorated inflation pictures and the change in the monetary policy stance are affecting growth prospects. But in North America, and this is a good example with Canada, where we didn't revise our GDP growth forecast, will also benefit, on the other hand, from rising global energy prices. So part of the impact will be offset by the rise in energy prices. So in the US, we still expect the net impact to be slightly negative, but in Canada, it will probably balances out. Looking at emerging markets, so here a more diverse reaction to the trend, but to the war in Ukraine. But I think we can highlight the fact that there are a few countries in green here, meaning that they are going to benefit from the crisis, and these are mostly oil exporters. So Algeria, Angola, Gabon in Africa, and most meaningfully Saudi Arabia in the Middle East. So this is the global picture as about 2 months after the war started. But if we look at this from an historical perspective, with the next slide, of course, the simple fact that prices and the rise of the price, the simple fact that international energy prices are rising so fast is a risk for the global economy. So in these two charts, you can see on the right-hand side that whenever the world energy bill has increased, there's been a massive slowdown in GDP growth. So that's very clear in the slides in the 1970s with the two oil shocks. And if we try to project the trajectory of the world energy bill, if prices were to reach again the $140 that they reached, we would likely have a recession at the global level. So looking at North America, so just a quick word now on political risks. Of course, with rising energy and food prices, we expect also political risk to be on the rise, especially in emerging markets. If we can move on to the next slide, we can see that on the right-hand side, food inflation is currently running very high, especially in emerging countries. And when Coface tries to use its in-house model to modelize to assess political risk, you can see that in 2021, after the pandemic, we estimate that political risk is at a record high in both emerging and advanced economies. So against this backdrop, we believe that the risk of social unrest has increased and is being compounded in the current environment by rising food prices. And we've seen that with recent examples of social unrest in Sri Lanka or in Peru, and we expect this type of major social unrest to continue going forward. So maybe now looking a little bit more at the U.S. economy and North American economy, and starting with the impact of the war in Ukraine. So as I was saying, and if we can move on to the next slide, please. As I was saying, the direct trade and financial links with Russia and Ukraine are very low. You can see from this chart that it's less than 1% of total North American trade in 2021. There are some key commodities that are coming from Russia. Nonetheless, the U.S. notably imported some petroleum products from Russia, and the ban on oil that has been pronounced by the White House last month is that's why it's impacting diesel prices at the pump in the current environment. We are also likely to see rising fertilizer prices and more scarcity on chemical fertilizer markets, because it's also Russia is also an important supplier to the North American market of fertilizers. So there are some pockets of stress that could occur because of some supply chain linkages, but overall direct trade ties are limited. So the main channel of the impact will be felt through rising energy prices and rising inflationary prospects. That's what we can see on the next slide. So if we look at inflationary developments in the US in the last 12 months, so of course we are all aware that inflation has now risen to 8.5%. But when you look at it from and try to decompose it with all the core inflation and also looking at energy and food inflation, you can see that energy and food inflation was already contributing a lot to the rising prices that we were seeing. And that's something that we are likely to continue to see going forward. So using a very simple model on the right-hand side, I try to estimate the direction of the orange contribution of the left-hand side chart, and that's what you can see on the right-hand side chart, depending on our assumptions for oil prices. So if I look at our assumptions at the beginning of the year was that prices of a barrel of WTI would average between $70 and $80. After the war, we expect the price of a barrel of WTI to average about more than $100 this year, and you can see that this is impacting quite meaningfully the contributions of energy items, and the simple and the simple revisions to the outlook for global energy prices raised our forecast for CPI inflation by about 1.3 percentage points. So at the beginning of the year, we were forecasting that inflation would average a little under 5%, with inflation starting to ease meaningfully in the second part of the year, driven notably by energy prices, as you can see from the chart on the right-hand side. But with this revised outlook, we are now close to, our forecast is now around 7%. So an overall 2 percentage points revision to the GDP, to the inflation picture in the US. And against this backdrop, of course, the Federal Reserve finds itself in a situation where it has to tighten aggressively to try to act not on energy prices, because rising interest rate is not going to do much to bring more oil supply to the market, but to reduce this blue bar on the left-hand side chart. So that's why in recent months, they have changed their rhetoric and are now turning more aggressive. And if we move on to the next slide, we'll see that in terms of their expectations, they have shifted quite dramatically. So on the left-hand side chart, you can see the interest rates, the actual interest rates and Fed funds rates from 2000 to the beginning of 2022. And you can also see with the dotted line, the projections of the Federal Open Market Committee. And you can see that back in September last year, they were expected to keep interest rates close to zero up to the end of the year. And after their March meeting, which was their last meeting before the one that they're holding and that they've been holding since yesterday, they have raised these expectations by about 2 percentage points. So we will likely find ourselves in a situation in the US where interest rates will likely exceed 2% by the end of the year. The exact final destination of the current tightening cycle and of the current rate hikes of the Federal Reserve is very unclear. And that's what we're expecting from today's meeting and today's press conference from Chairman Jay Powell, is more direction on the final destination of interest rate increase. But in my opinion, considering demand dynamics, it is likely that they don't have a lot of room to go above 3%. So that's why I think they will likely be around 2.5% by the end of the year. And this is very important for the Federal Reserve to act aggressively, though, to try to contain inflation expectations. And because inflation expectations are ultimately the main factor driving inflation. Why? Because if businesses and consumers expect prices to increase by 4%, the wage and price increase will be reflected in the actual world. So one of the main indicator that I like to look at when looking at inflation expectations are more medium-term inflation expectations. And you can see that although they are on the rise, for now, they are still relatively anchored. And this is very important for the Federal Reserve to stay on that course going forward if they want to avoid avoid inflation and the inflation narrative going out of control. But this will be a very perilous balancing act for the Federal Reserve, because on the one hand, they can, if they don't act forcefully enough, inflation would run hot for longer and would ultimately hit growth and the profitability of businesses and the of American consumers. But if they act too forcefully, they risk pushing the economy into a recession. So there is definitely a difficult path and a narrow path for the Federal Reserve to achieve in the next 18 months, what we call a soft landing. So to conclude, I just have a few concluding remarks. And I'd say that at the beginning of the year, we were highlighting three main risks for the global economy. We were saying that monetary policy normalization could derail the recovery. We were saying that COVID-19 was still a risk and that it could disrupt supply chains. And we were saying that geopolitical risks could be the black swan that also impact the global economic outlook. And 5 months later, when we look at these three factors, we can see that the risk picture has deteriorated on all fronts. So definitely a more challenging outlook going forward, and a likely stagflation scenario, at least in Europe. So an outlook that has definitely become harder to predict. But now we will try with John to look a little bit more in details at specific risks in specific industries and how this risk picture and the recent months have impacted our credit risk outlook in sectors.
Thanks, Ruben.
Thanks, Ruben. John Goggin here. I'm one of the risk managers at Coface. So our function is to take all that great information to Ruben and try to interpret it into how we want to underwrite different sectors. If you go to the first slide, I think based on, Ruben, everybody's talking about inflation, 8.5%, the highest it's been in a long time. But what was shocking to me was when you look at the individual commodity prices. We see the chart here, and oil is up 80% in a year, jet fuel 48%, heating oil 46%, all the metals are up 50, 20, 10, 84%, lumber 41%. So this is the beginning of why we're seeing the inflation, as companies are paying more for the raw materials to produce their products. Our concern is that they're paying more. What can they sell the products for? Can they get some of this money back through the sales process? And how are they financing this? So they're paying 80% more, 50% more for product. And that puts a strain on their cash flow, on their sales cycle, and can they recoup that, or they going to have to eat some of the costs? So that's from an underwriting side, it's a very difficult thing to predict where this is going in the next 90, 120 days. I guess today the Fed's going to raise interest rates by another 0.5 point. And they're looking at June for another rate increase. So it's going to be either 1/4 of a 0.5 point in June, probably. Puts a lot of strain on companies when they are trying to refinance their debt. That's going to be more expensive, and banks and finance companies are a little bit more hesitant now than they were last year to refinance. So there's a lot of issues with the lower rated companies on refinancing debt going forward. On the next slide, a quick look at the wheat prices, what they've done over the last 3 years. And this has a major impact on the chemicals for the fertilizers. So, wheat prices are up. So, is less wheat going to be produced? How is that going to affect the producers in the chemical side for fertilizer? So we're concerned about that. Next slide. Again, what Ruben said, the agri-food prices are very high. That eats into consumers' discretionary spending ability, which, goes into different aspects of what they can buy, what they're willing to buy. The luxury items that people are spending on their homes. Is that now going to demand for that is going to wane because of paying more for food and more for heating oil and the basics of getting by? And on the next slide, I'm trying to go a little quick since we're getting a little short on time. You're looking at some of the producers here. So you take a look at like United States Steel, what they've been able to do. Their price per ton has really grown dramatically. So they're able to sell the same product they did last year at a 63% more than they were last year. So their average selling price went from $718 a ton up to $1,172 a ton, which if you look at the top line for their sales went from $9.7 billion to $20 billion without really doing anything, substantial for that increase. Gross margin last year was 1%. Now it's 27%. Having a great year. They made $4.1 billion versus a loss last year of $1.2 billion. cash flow went from 138 million to $4 billion. You know, they're able to pay down some of their debt. It went from 4.7 billion down to 3.9. And they're, you know, with this cash flow, what they're able to do, you know, they estimate they could generate more than 2 billion in free cash flow this year. And that's double their S&P's estimate of only a few months ago. So what they're able to do with all that extra cash is deleverage their balance sheet. They completed the sale of acquisition of Big River. They repaid debt, and they're able to boost liquidity and to fund a new mini mill. So companies like U.S. Steel, Nucor, Cleveland Cliffs had a great year. The issue we see is the companies that have to buy this now very expensive steel, and how can they pass that cost on to the consumer or the end user? So if you look quick at the next slide, just Ford, you know, big auto producer, we know there's some shortages in the chip sector. You know, they've been lucky from the standpoint that their unit sales are down. So 2021, they sold 3.9 million vehicles, down from 4.1 million vehicles in 2020. But they were still able to remain profitable because of the supply of cars is limited, and they're able to charge higher prices. So you go into a car dealer, you're not negotiating down from the MSRP, you're paying MSRP or higher at this point. So they're able to, you know, keep their financial stability because of this shortage. Now you see interest rates going up. So, you know, people are they going to be able to afford buying all these new cars when supply comes back? And that's when you get into sort of the stagflation that Ruben was talking about, is you're going to, you know, supply will come back, but will demand be there when the supply is there? So you could have a growth in supply and a limited growth in demand, or a decrease in demand with the interest rates going up. So we're not too concerned with Ford themselves, but the real effect is going to be on the tier 2 and tier 3, tier 1 producers, as they're very closely tied to Ford's production. So if Ford's production starts to wane because of demand, what's going to happen to those tier 2 and tier 3 producers? Now they have to buy more expensive product, they have to finance it, and if they can't sell it at a higher price to Ford, you know, there could be issues on that side. So again, the top layer with U.S. Steel, with Ford are going to be doing well, but it's the second and third tier who have to buy this expensive product and try to recoup their more expensive costs on their selling cycle and finance that. So if you go to the next slide. So you can see the U.S. auto sales, they really took a dive in 21. They came back a little bit at the end of the year. And because of the current supply chain shortages, like Ruben mentioned, China is having issues with their lockdowns, and their chip production is down. Yearly forecasted sales in March was 13.4 million units, when their average is 16 or 17 million. And it looks like in April, that's going to dive even further. So we're looking at probably 12.5 million worldwide units being produced, when the norm is close to 16, 17 million. So again, you know, a lot of pressure is going to be put on the suppliers. Can they downsize their operations, remain profitable and viable in this environment? So that's, you know, something to look at that we're concerned about in the next 6 to 9 months. So a couple more quick slides. If you look at the airline industry real quick, you know, they pay a lot, like 30 to 35% of their costs is in the jet fuel. And you can see we did a quick comparison of the top 4 airlines. Really the difference is, if you look at 2019 as a base year, when United, for example, their revenue was 43 billion. really got hit in 2020 with the pandemic. And last year they started to come back. You know, if anybody's been flying, the airports are crowded and planes are pretty much full, but still sales are only rebounded to 24 billion last year. So way away from where they should be to be normalized. They're still losing money. Long-term debt for United went from 13 billion to 30 billion to try to sustain, these lower sales. Labor shortages are hurting them. Tough to find new pilots at this point. They did try to bank a lot of cash at 18 billion, but airline industry, I think, has a long way to go to get back to any normal operating rhythm. So, hopefully this year with the Omicron kind of dying out and people getting back to vacations, that will increase. But then again, you have the inflation, the interest rates, food costs. So is discretionary income going to hurt their ability to bounce back? Okay, so just last slide. Just in general at Coface, what we've done with our exposure, as you can see, in 2020, we had a lot of reduction actions as the pandemic started, and we've really bounced back. So we've added 33% more exposure in 2021 because of the the strong economy. And we're even up 14% because of pre-pandemic levels. And we see that trend continuing, though I think we're going to have some pockets of volatility in certain sectors like the tier 1, tier 2 auto suppliers, some of the manufacturers who have to use the more expensive steel and input costs. So it's going to be, I think, a volatile next 6 to 9 months to see where the interest rates go, see if the Fed can control inflation a little bit and get things a little more back to normal. But I think, like Ruben said, the U.S. has been pretty good. Europe is taking the bulk of the volatility at this point with the energy prices, and if Russia, or they determine not to buy any more Russian oil, that'll be additional shock to Europe. So I think the energy industry in the US, I think, will benefit from that, as the energy is going to have to come from somewhere. The OCTG segment of the economy, I think, was struggling as oil prices were down at $40, $50 a barrel. Now up at over 100, they're cranking up all the rigs, and I think that segment is going to have a pretty good year this year and into next year. So try to do that as quick as possible, but I guess we have time for questions at this point.
Thanks, John. Yeah, so that was a lot of information, very helpful. I'm sure there might be some follow-up questions. So you can please go ahead and enter those into the chat or the Q&A section, and we will take the time to answer as many as we can now. And if there's any that we can't get to, we can follow up after. Okay, I mean, the one question we have is if we're able to share the presentation and the slides, and yes, I believe we're going to have a recording of the presentation, and we can share the slides after.
Well, Kim, I actually have a question. After hearing Ruben and John talk a little bit, just the airline results were pretty shocking. I hadn't really seen those numbers presented like that before. We all know the airlines haven't been doing well because of the pandemic, but just seeing the difference between those few years and some of those numbers was significant. But I'm just wondering what you think. I mean, can the airlines get back to where they were? In terms of revenues and everything else. I have to think that business travel had a big impact on revenues. People just stopped traveling. It's picking back up again. I think face-to-face meetings will always be a part of business, but these online meeting platforms, Zoom, Teams, and the others, I mean, they very quickly have become very firmly entrenched. And I don't know if a lot of people will travel for business as extensively as they used to, and if the airlines, will kind of get back to where they are anytime soon. Just curious if my impression's there, if you think that's right or not.
If you look at like Southwest as more of a domestic carrier, they're still making money. Their sales were down from 22 billion and they're back up to about 16 billion, but they're making money. They're triple B rated, so they've been able to get by this. I think the international travel, United, American, and Delta, that kind of hurt them on the international side. I think they make a lot of money on the international and the business travel. Business travel is starting to come back. I think all this is manageable. They did get the government involved way back in 2020 to help bail them out. So I think that is a possibility too, if it ever gets to that point. But, they have come back. You look at United in 2020, they lost almost 7.5 billion. And last year they lost 1.2 billion. So they are able to adjust. And I think travel will come back, whether it gets back up to the 43 billion from the 24 billion. Break even for them is probably close to 30 billion at this point. So I think, they're headed in the right direction. And, assuming that the US economy stays pretty much where it is, I think they'll be able to come back from this. It's going to take time. They still have $20 billion to pay off to get back. But like with auto manufacturers, when they make money, they make a lot of money. So hopefully with their cash flow turns positive and they can start paying some of this back in the next few years. But I think they do have 18 billion in cash, so they are pretty stable at this point. But again, you're right. It's going to take time for them to try to get back to a 19 type of level.
Thanks, John. We have a few questions in the Q&A. First is, do you have an outlook for the chemical sector? And then also a follow-up to that, impact of energy commodities on chemicals.
Chemicals is tough. I mean, it's such a broad industry. There's so many different, but I think it's a pretty stable industry outside of the fertilizer part of it. Energy is a big component of manufacturing the chemicals and transporting the chemicals, so that those costs will be up. And again, it's depending on the particular chemical, how can they recoup that cost from the end user? Haven't seen too many big issues in the chemical companies to date, but I think if the inflation continues and food prices continue, I think that will have a bigger impact down the road. But we haven't seen instances of claims coming in that sector at this point. So I think that's one of the most, chemicals is always one of the most stable industries that we have.
Okay, great. And so we have about 1 minute left, and I know we still have a few questions, so I think perhaps we'll just have to take those offline and follow up directly. I just want to take a minute to thank all the presenters and panelists for joining us. Very interesting information and speaks a lot to what we've been experiencing, and certainly the impact on the markets and this industry. After the call, there'll also be a short survey. So if anybody has some time, it'd be great if we could hear from you on our presentation today. It would help us for the future. Thank you all for your attendance, and see you next time.
Thanks. Bye-bye.